Everyone knows that the United States is filled with some of the highest quality dividend growth stocks in the entire world. Think of companies like Coca-Cola, Microsoft, and Visa. But as you may already know, if you look internationally, you might find some interesting opportunities as well. So in this video, we're going to be looking at 5 of the top European dividend stocks. And I've actually already added one of the stocks we're looking at today to my portfolio this year. To analyze these stocks, we'll be using my automated spreadsheets from tickerdata.com. While most softwares are limited to just US stocks, TickerData allows you to analyze stocks from all across the world, which is perfect for stocks we're looking at today. You can get a 7-day free trial to TickerData at the link in the description. Now let's jump in. Now the first stock we're going to be looking at is a high yielder that actually trades on the London Stock Exchange, and that is British American Tobacco, and the stock ticker is BATS. And this .L stands for the fact that it trades on the London Stock Exchange. And we can see over the past year, they're up around 5%. So they're up a little bit, but relative to the S&P 500, they have underperformed. Now, if we jump over to our dividend breakdown sheet, again, TickerData can look at international stocks. So we'll plug in the stock ticker BATS, and because it trades on the London Stock Exchange, we'll just type in a .L and hit enter. And again, all this data is going to automatically load in, even though it trades on the London Stock Exchange. If you go over to tickerdata.com, you can see a list of all the different available exchanges that you can plug in using TickerData. But like I mentioned, we can see this company is a high yielder. It's sitting at about 8.51% starting dividend yield. So they are paying out some massive dividend payments. Now, one of the things that pops out down here is it has a negative payout ratio of 35.18%. Why is this? Well, you have to understand the company took a massive $27.3 billion write-down on its US brands. And this was following the acquisition of Reynolds American, which significantly affected its profitability. Now, we also have to keep in mind, because we're looking at international stocks, these numbers can also be affected by currency fluctuations. Now, on the bright side of things, if we look on the free cash flow payout ratio, we can see the free cash flow payout ratio is just 49.3%. And this is the reason I like looking at free cash flow more than the earnings payout ratio for most companies that I look at. The free cash flow won't lie to you. It can't easily be manipulated by the management team. And if we look over here at the free cash flow versus dividends paid out, we can see for the entirety of the past decade, free cash flow has been covering those dividend payments. In 2023, the company generated about $10.2 billion in free cash flow, while dividends paid out was sitting at about $5 billion. So that's pretty healthy. If we look at the free cash flow payout ratio over time, we can see it looks like since around 2019, it's been sitting pretty close to 50%, and it's even lower than it was at the beginning of this decade. So overall, this is a good sign for the sustainability of those big dividend payments. If we look at the yearly dividends, we can see overall they are growing. But one thing we do have to mention about these European dividend stocks. Most European dividend stocks aren't like American dividend stocks in the fact that they pay out the same amount every single quarter and then increase the dividend after every single year. A lot of these companies will either pay out semi-annually or sometimes even just once a year. So for example, if we scroll down and look at the quarterly dividends for this company, we can see on a quarterly basis it fluctuates a little bit more, but again, it kind of evens out when you look at it on a yearly basis. Now if we jump over to our stock screener sheet, come up here and plug in BATS.L again, and here's what we can see. Right here is the culprit for that negative payout ratio in 2023. Like I mentioned earlier, negative earnings per share, which led to that negative payout ratio. But overall, we can see revenue per share was growing earlier in the decade, but it's slowed down a little bit over the past few years, and the same is true with free cash flow per share. Now, on the bright side, shares outstanding hasn't changed, so they're not really buying back shares. Buying back stock is not something as popular for European stocks. A lot of the times, European companies generally have less aggressive buyback programs. Now, if we keep moving forward, we can see the debt to assets ratio has gotten a little bit healthier throughout the decade for the company, but it wasn't necessarily in a bad place to start with. Then obviously one of the concerns is because of the negative earnings, the company had negative return on invested capital in 2023, which not a good sign, but I don't think that'll be the case moving forward. Now, if we look at the profitability and income statement sheet, something we will really like here is look at just how profitable the company is when it comes to the gross profit ratio. The 10-year average for the gross profit ratio is close to 80%, and in 2023, it was as high as around 83%. So we can see consistently high gross profit ratio for the past decade. That's the sign of a quality company. And typically, these types of companies have a lot of pricing power. Our next company is one based out of France, and that is L'Oréal. And this company actually trades on the over-the-counter markets, and we can talk about that in just a moment. But in the past year, we can see they're up around 10.74%. But what we can see right here is in just the past few days, they've seen quite a spike up in their share price. In fact, if we look at just the past 5 days, they're up close to around 10%. Now, why is this? Well, we have to keep in mind, what is this company selling? What are they offering? Well, this company sells luxury brands. They have fragrances, hair care, cosmetics, and skincare. And a large part of their market is in China. Well, in just the past week, China announced they're going to be launching a stimulus package for their citizens, which gave a huge boost to luxury stocks. Now, if we jump over to our dividend breakdown sheet, come up here and plug in LRLCY and hit enter. And what we can see is the starting dividend yield for this company is lower. It's sitting at about 1.56%. So a big difference from the last stock we just looked at. And the payout ratios look healthy at about 55 and 56%. And we can see a history of dividend growth. But one of the things I also want to point out is the dividend growth has actually been pretty good. Look at the 5-year dividend CAGR sitting at about 10%, the 10-year at about 7%, and the free cash flow has easily been covering those dividend payments for the entirety of the past decade, and the dividend growth is also backed by growing free cash flow. So this really checks all the boxes for things that I typically look for. Now, one of the things I will say about this company is they typically only pay out dividends once a year, so that is something to take note of. Now, if we go ahead and jump over to my stock screener again, we'll come up here and plug in LRLCY. And from an earnings growth perspective and a free cash flow growth perspective here, I actually really like what I see over the past decade. This is a beautiful free cash flow growth chart over the past decade, going from around 88 cents per share in 2013 to now all the way up to $2.28 per share in 2023. We can see return on invested capital has actually been pretty solid, especially over the past 3 years, close to around 17, and 15 to 16%. That's pretty solid, and this company's also been buying back some shares as well. Now, at first, it might look a little alarming when you see the jump up in debt to assets ratio, but it's still actually very low, only around 15%. So that's a pretty low debt to assets ratio. And then again, if we jump over to our profitability sheet, this is another company that has consistently high gross profit ratio. In 2023, it was 73.86%, again, very high, and I love seeing the consistency again. Again, that is a sign of a quality company that typically has pricing power. When you talk about a company that is a luxury brand, those companies typically get the pleasure of having luxury margins, which is exactly what we're seeing here. Our third company is based out of Denmark, and it's a healthcare stock, and that is Novo Nordisk, and they're currently trading $120.76 per share, and the past year has actually been really good for the company. They're up around 31.56%. And that's despite them being down around 5% in the past 5 days alone. So let's go ahead and start jumping into this company. If we go over to my dividend breakdown sheet and come up here and plug in NVO and hit enter, and this company is a low yielder. The starting yield is sitting at about 1.2%, but the dividend growth has been phenomenal over the past decade. You can see a steady history of growing those dividend payments and a healthy payout ratio as well. And if we look at the payout ratio over time, for the most part, it stayed in a healthy range. Now, the highest it got was in 2020 when it got to about 67%, but I still don't think that was too big of a problem. And we can see free cash flow, especially since 2020 has exploded. 2020 free cash flow was sitting at about $29.8 billion, and look at how much it's grown, and in 2023 it was sitting at over $70 billion. So massive free cash flow growth during this time, which in turn will allow them to grow those dividend payments at an even faster rate. Keep in mind, this is a company that typically makes semi-annual dividend payments. Now, if we go ahead and jump over to our stock screener, we'll come up here and plug in NVO, and overall we can see some good sign. It looks like we're seeing growth with the top and bottom lines. Now, what's really impressive is how good return on invested capital has been over the past decade for the company. It's been ridiculously good. And in turn, if we go back over to Yahoo Finance and look at the past 5 years, we can see the company's up over 362%. So not really any surprise to see a company perform that well when they're growing free cash flow and have high levels of return on invested capital. Now, if we jump over to the profitability and income statement sheet again, another company with very high gross profit ratio, a great sign of a quality company, and it's staying consistent over the past decade. We're seeing double-digit revenue growth, double-digit net income growth. It's no wonder this company's seen such a run-up in its share price over the past 5 years. I would go as far to say that this is one of the kings of dividend growth in Europe. Our next stock is one that I own in my personal portfolio, and that is Louis Vuitton. Stock ticker LVMHF, and it's currently trading at $781.10 per share. Now, this is another company that operates in the luxury goods sector, and it's considered a global leader. We can see over the past year, it's up around 5%, but look at this, in just the past 5 days, like we saw earlier, up 17.5% because of the China stimulus package. Now, if we jump over to my portfolio and blow up my growth chart, we can see right here, I'm currently up around 11.15% on this position, so the past 5 days have really helped my personal position in this company. Now, obviously, short-term gains are great, but I'm in this for the long haul, and let me show you why. We'll start by going over to our dividend dashboard. Again, LVMHF, and hit enter. And here's what we're gonna see. The starting dividend yield sitting close to 1.8%. We can see the payout ratios look healthy, but the dividend growth has been really good since 2014, especially in the last couple of years. They've been making some massive dividend payments. Now, why have they been able to do this? Well, it's because the free cash flow has grown so much over the past few years. Look at the jump from 2020 to 2021. They went from around 8.3 billion in free cash flow all the way up to 15.4 billion in free cash flow. Now, the past couple of years, it has dropped down. Even then, look at the 5-year dividend CAGR for free cash flow, 12.4%, the 10-year, 13.5%. So this company is a dividend growth machine because they're a free cash flow growth machine. Now, keep in mind, again, this is another company that pays out dividends semi-annually, so that's something you have to keep in mind. Now, if we go ahead and jump over to our stock screener, this data will load in, and I really like what I see. First off, we can see the top lines are growing, and they've grown pretty significantly over the past decade. It looks like they've 3x'd. Same is true with earnings per share, grown significantly, and then free cash flow per share, the same is true. But here's what's also impressive. Return on invested capital has been pretty good for a retailer over the past 3 years. 18%, 19%, 19%. Keep in mind, typically for a baseline, I want to see at least 10% return on invested capital out of the stocks I invest in. Anything that starts getting closer to 20%, I consider that a pretty high quality company. Now, if we jump over to our profitability sheet, again, the company has a high gross profit ratio because they have luxury goods. They can price their products at a premium because of that. If we look at the revenue growth over the past 5 and 10 years, we're seeing double-digit growth. Net income growth over the past 5 and 10 years, even closer to 20% growth. And this company is actually down pretty significantly from its all-time highs. I've been talking about it in my weekly newsletter, which you can sign up for at the link in the description. But if we look at the past 5 years, we can see they are up around 97%, but at one point they were trading as high is about $999 per share or even $1,000 per share. So they're down pretty significantly from their all-time highs. And I started adding this position to my portfolio when it was trading in the low 700s. But as for me, I'm a dividend growth investor. I'm looking to buy stocks that have an okay starting dividend yield, but massive potential to grow those dividend payments in the future. And because they've grown their free cash flow at such a healthy rate moving forward, and because they're a global leader in luxury goods, because they have so much pricing power, I expect this to continue in the future, which will then allow them to continue to grow those dividends at a high rate moving forward. And then lastly, we have another luxury goods company that is based out of France, but the returns this company has seen over the past year are quite different than the other luxury companies we've seen. They're up almost 38%, and that is Hermes International, trading at $248.40 per share. And if we look at the past 5 days, like the other luxury companies, they're up around 15.29%. Now, the stock ticker for this company is HESAY. So if we jump over to our dividend breakdown sheet and plug that in, and out of all the companies we've seen so far, this one is the lowest yielder. It's below 1%. It's sitting at just 0.65%. But look at how much their free cash flow has grown from 2013 to 2023. It went from 685 million, now all the way up to nearly 3.5 billion. So as a result, yes, they have been increasing their dividends, but the free cash flow payout ratio has actually been declining over the past decade because free cash flow has been growing at such a rapid rate. Just the past 5 years alone, the free cash flow CAGR is 19%. The past 10 years, 17.6%. So we have healthy payout ratios, rapidly growing free cash flow, and because of that, a healthy growing dividend payment. Now, what's interesting about this company is they typically make 2 dividend payments a year, and it's typically in Q1 and Q2. We jump over to the stock screener. Again, we'll come plug this up here. And when you look at the way that earnings and free cash flow have grown over the past decade, it's pretty evident why they've seen so much growth. Again, if we go back over to Yahoo Finance and look at the past 5 years, they're up around 261%. Earnings per share in 2013 were around 75 cents per share, and at the end of 2023, $4.11. So bottom lines have been growing, top lines have been growing. We can see there was a spike up in the debt to assets ratio, but still in a very healthy range, nothing to be concerned about as well. But then if we look at return on invested capital, this is perhaps the most impressive aspect for this company. Again, ROIC is telling us how profitable the projects are that the company is investing into. And as a baseline, I want to see 10%. But this company has been consistently getting above 20%. That is a sign of a high quality company. And then again, if we look at the profitability spreadsheet, they also have very high margins. So the combination of high margins, growing free cash flow, and very high levels of return on invested capital absolutely make this a high quality company. Double-digit net income growth and double-digit revenue growth. Pretty much everything I want to see is right here. So there you go. Those are some of the top 5 high-quality dividend stocks out of Europe. Like always, you can track and analyze stocks internationally by getting the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet. You'll also get access to all the spreadsheets that you see in my videos. So go ahead and let me know what you think of these companies in the comments down below. And like always, please don't forget to like and subscribe to the channel.